The time is here. We are less than 24 hours away from what everybody has been speculating to be the most tectonic Fed monetary policy announcement in the better part of 3 years. It was in June of 2021, in the wake of the COVID pandemic, that the Fed came out and essentially admitted that its assessment of inflation as a transitory thing was not the way that things were developing, and that it will need to move forward with hiking rates. It signaled in November of last year that that hiking cycle was done. It signaled in July of this year that the cuts are likely to begin in September. And of course, this is precisely what we're going to focus on here. This is Macro Money. I'm Ilya Spivak, head of Global Macro here at tastylive. We stand at the precipice of this shift. And the question that we are wrestling with is perhaps not so much whether it's going to happen or what the Fed can or won't or will do, but whether what the Fed does is going to be met with enthusiasm or disappointment by the markets. Because when you arrive at these points where speculative fervor is unwinding just because whatever event the markets were speculating about becomes reality and there is nothing left to speculate about, it is here that volatility is either discharged into the ether or ramped up, because the markets realize that either where they're positioned is wrong or right. And there is finality and resolution. And if they are right, then there's no impetus for asset values to go very much this way or that, because the markets are already priced in an accurate way, give or take. Or the markets are wrong relative to what occurs. And of course, you can have a semantics argument to say it's not the markets that are ever wrong, it's the Fed that'll be wrong if it doesn't do what the markets say. Ultimately, that doesn't matter. If there is a mismatch between expectations and reality, there will be a need to reposition, and that is a recipe for sharp moves across financial markets. So what we are going to do here is first take a look at what the baseline expectations are, and then consider what might be the reasonable way to tactically position for this, given the scenarios on the table. So first, the market is overwhelmingly tilted at this point in favor of a 50 basis point rate cut, which would be a double-sized move relative to what is usual. The current Fed funds rate in a range from 5.25% to 5.5%. One normal step lower would be 25 basis points down. That's assigned a 35% likelihood now. 65% chance that we get 50 basis points of a step down, and we end up in a range from 4.75% to 5%. The way we got here has been, needless to say, eye-catching. Consider that while we haven't moved very much relative to yesterday, we started this week with a sort of 60-40 split in favor of a double-sized cut. A week ago, the markets were much more inclined to the exactly opposite result. Over 60% chance, almost equivalent to where we are now, that we're going to get a single rate cut. And if we look back a month, that conviction is even stronger. What's interesting here is that, of course, last week gave us inflation data that suggested there isn't necessarily a ramping into a 50 basis point cut, that the Fed doesn't have an emergency on his hands, doesn't need to rush, and that this is fine. And there really hasn't been a lot of dramatic economic data or developments of any kind since that move to shift us now in favor of this 60 basis point cut or a 50 basis point cut with an over 60% likelihood, other than this is where the markets think we're going. There hasn't been a catalyst. There hasn't been anything that would suggest, oh, inflation is falling too quickly or growth is unraveling more aggressively. None of those things have occurred. The last major inflection point was this CPI data a week ago, and it signaled that we really don't need to move more aggressively than a 25 basis point cut. Now, why might the markets be looking for the more dovish outcome, regardless of immediate figures? Well, this has been the trajectory, basically, since May. As we can see here, from the policy announcement on May 1st, where the Fed first worried aloud that inflation wasn't falling fast enough and signaled that it might look to cut less both this year and next to make sure that it gets to its 2% inflation target. Down to June, when it actually made that concern official, cutting its expected rate cut outlook for this year. Over to July, when it signaled that rate cuts now are imminent and would probably arrive in September. Over to now, there has been a steadily dovish shifting. And as we can see, the meat of that dovish shifting has focused on what happens not this year, but next year. And in between July and now is where the most move occurs. So you can see the difference from May to June, somewhat small. From June to July, a little bit bigger, a little bit more dovish. But from July to now, there's a big wedge right here. So the markets have become very, very dovish. And if we look at what this implies, we can see that by July of next year, we are looking to be essentially 2.25% lower, from 5 to 3, and then about another a quarter of a percent in cuts thereafter, which is a huge amount of cuts in such a narrow period of time. Why is the market tilting so dovish? Well, one explanation for what has occurred here in this period from May to now is that U.S. economic data has looked increasingly soggy. We can see here from about mid-April or so, U.S. economic data begins to sour relative to forecasts. And by the time we get into May, it isn't just surprising higher by a narrowing quotient or aligning with expectations, which would be 0 on this index. That would be no surprise, upside or downside. So that would be data is coming out in line with forecasts, or tending to. Here, from around the beginning of May, which lines up very nicely with this baseline here, we start seeing that U.S. economic data begins to serially underperform relative to forecasts. And This is all while the Fed is reluctant to begin cuts. And so the markets reason that what we'll need then is maybe not quite as much up front because the Fed is reluctant, though, of course, the trajectory has been more and more dovish, but a lot more later, which is why this sort of fans out on the downside. If we look at the way that this has worked out in stock markets, here's the full rate cut cycle from now through the end of next year, according to what is baked into Fed funds futures. In the gray is this year, in the yellow is next year. And we're looking at a sum here in the orange, giving us 228 basis points in rate cuts, which, not surprisingly, is a vast expansion from the 76 basis points that we expected over the same period in the middle of April, which is right here. So, what has been interesting is that the relationship between this increasingly dovish outlook and stock markets seemed to change. Markets seemed perfectly fine with some future rate cut and seem perfectly happy to be building out these expectations. Stocks we can see here moving higher as the outlook grows more dovish until July, when the Fed actually signals its likely go time. And the policy announcement is here, but the Fed begins its signaling earlier when Fed Chair Powell sits for congressional testimony, the semi-annual outing where he first goes to one house of Congress and then another and basically tells them what the Fed's been doing for the 6 months before and what it thinks it's going to be doing for the 6 months ahead. So when we look at what happens then, we can see stocks go down even as things grow more dovish, ostensibly because the markets have recognized that we see the Fed as having somehow missed the boat. That is, they haven't cut enough or should have cut sooner because the economy had been showing signs of weakening from here onward, or because they think that the Fed's reluctance will mean they'll move too slowly when they actually do start cutting, or some combination thereof. The most sort of charitable explanation might be that we got to this high thanks to increasingly dovish policy expectations. We can see here's where stocks started. We were looking at much less in easing then. The pathway has been from this point, late October, early November, when the Fed first signals it is done hiking and is going to cut as its next move, a move toward increasingly more dovish, and a move to increasingly higher stocks. So most charitably, the speculative interest in the narrative has essentially run out. And since then, we've seen some chop, but the outlook has grown increasingly dovish all the same. Now, of course, where this is setting up at this point is vastly more dovish than the Fed's update in June. And of course, its own signaling means that there is some level of revision that it is already prepared to do. But it is worthwhile to have a look at just how far we've come and to put that in context for what the markets now expect. This is the last time that the Fed updated its official forecasting. It will update it again with this announcement tomorrow. For this year, as of June, the Fed saw just one cut from an effective rate of 5.3 down to 5.1. And of course, we're rounding here, but that's one cut. From there, we expect 4 cuts in 2025 for 100 basis points from 5.1 to 4.1. And we're not looking as far as this because frankly, nobody knows what's going to happen that far out, but they roughly penciled in another 100 basis points thereafter. Compare that with what the markets see now. We're sitting here at about 100 basis points for this year alone. So that's at least a 150 basis point rate cut at one of the next three meetings. There's just the three: September, November, December. To get to 100 basis points across those three meetings, one of them has to be a 50 basis point cut. So obviously that's very far from what this says. And then for next year, we can see here we are from 1, again, down to about 2.25. So that's at least another 125 basis points in cuts next year. And in fact, it's tilting a little bit where this year is about 95 and next year is about 135. So the tilting next year, rounding off again, is for 5 cuts, and that means that this is light by at least 1. And indeed, the levels implied here suggest that while next year the average is looking at 4.1, we're looking at something much, much lower, where by July we're already at 3. So, needless to say, the Fed's own signaling means that they're probably going to revise all of this in a more dovish direction, but the question is, can they revise it dramatically enough to meet the markets where they are, and what the markets will do if the Fed doesn't go as far as we already sit? So the first thing to consider here is the dual risk of underreacting and overreacting. If the Fed gives the markets exactly what they want, well, then there's not much speculative interest there, other than to say, as we looked at here, markets had a nice big run around this dovish speculating, and this might just be a trend that's over, because speculation is about to become reality. And then the risk is that there's just some level of a profit-taking impetus because the narrative has run its course. That might be the most benign version, and it amounts to a buy the rumor, sell the fact sort of a dynamic, at least in the near term, for stock markets. Let's say the Fed doesn't deliver broadly in line and underwhelms. Let's say the shift isn't as dovish as the markets are currently set up. There is some logic there, but the markets might clearly be disappointed. The logic, very plainly, is there doesn't seem to be a growth emergency. It is certainly concerning that, looking at PMI data, we have manufacturing woefully underwhelming here, but the overall economy is powered mainly by the service sector, and we're looking at growth that's sitting near the top of the range since May of last year. It's not a dissimilar story looking at the ISM version of this. Again, very disappointing story on manufacturing, and it is certainly concerning that it tends to be leading what's going on in services, but things are holding up in services. It's not incredible growth, but it's near the middle of a range that's persisted really since the tail end of 2022. Doesn't seem to be an emergency here. In fact, if we look at the Atlanta Fed's GDP now forecast for growth, we can see running data for the third quarter give us an estimate of 3%, which is quite high relative to market forecast. So there is a case for the Fed to say, well, this is just very dovish forecasting from the markets. We're not going to endorse it to that kind of an extent. We'll get a little bit more dovish, but not like that. And then the risk is the markets are disappointed because they end up with more expensive money than they've already discounted in the future. And so there is a need to de-risk. Whether they ultimately buy the pro-growth story once the dust settles seems to be another matter. There's so much speculative fervor now that if you end up with a 25 basis point cut and insufficiently dovish signaling from the forecasting and the press conference with Fed Chair Powell after the meeting, the markets might end up feeling deflated and unwilling to take risk. On the other hand, if you overcorrect, you give the 50 basis point cut, you take a giant knife through these forecasts for growth and inflation and rates and give the markets the most dovish of dovish outcomes, well, then you might well have a panic on your hands because the markets already suspect the Fed is behind the ball or is moving too slowly to really engineer a soft landing. They already suspect the market has become tighter than it needs to be. We can see that here. Clearly, this is telling us that economic conditions are such that things have become increasingly dovish, and we can see why. Again, this is where the data started to miss, just as this outlook started to become more and more defensive. So, do too little, and the markets are left disappointed. Do too much, they're left scared. And what that leaves isn't necessarily the impossibility that the Fed manages to stick this landing and give the markets enough that they are satisfied. Needless to say, that's a completely viable path forward. But it does suggest that there are more risk-off scenarios on the board here because of the speculative fervor leading into this outcome and its apparent disconnect from the economy itself. Then there are scenarios where the markets are easily met where they are and ultimately take what happens here as a risk-on signal. And so the path of less resistance seems to be lower for stock markets and perhaps higher for the US dollar, because either the Fed is more hawkish than the markets want, and that's bad for stocks and good for the dollar on yield grounds, or the Fed is much more defensive than the markets want to hear. There is a growth scare. That's risk off for stocks, but then the dollar benefits from liquidation as capital shifts away from risk and toward liquidity. This could certainly also land in a scenario where stocks are higher and the dollar is lower. That is by no means impossible, but the likelihood of that scenario seems asymmetrically lower than the alternative. And that is macro money for today. As ever, we are here Monday through Thursday, right after overtime, a show that I co-host with Dylan Radigan and Chris Vecchio, looking at the Wall Street close and what that might beckon thereafter. I'm on with Victor Jones for the Price of Truth on Wednesdays, on with Chris for Futures Power Hour on Fridays, back with Victor and Tom for First Call on Sundays, writing for the news and insights portion of tastylive.com, and opining sporadically on the platform formerly known as Twitter at Ilya Spivak. Thanks very much for joining. Good luck out there. Macro Money is back tomorrow.